Hey there, everybody. Happy Friday, March 21st, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully cool and overcast Redmond, Washington. I always do one quick glance out the window to check the weather as I'm reporting in. That started as a joke years ago when I did a show on Stock Charts TV every day, and very happy to continue that daily weather report from Redmond, Washington, as we continue on this show here. Thanks so much for joining me. Those that have tuned in live as we do the broadcast. We actually recorded this a little bit earlier on Friday, just right around the market close. So we're going to do a brief market recap and then get right to 5 or 6 really good questions that I received here over the last week. All of these questions I'm about to share with you have come from people like you watching the show, asking questions either during the live stream or watching the replay on our YouTube channel and putting a comment there. I read every question that we receive personally, and I can't thank you guys enough for keeping it interesting, giving me ideas of things to cover on the show. And it's a pleasure to answer some of your questions and do it for everyone's benefit, hopefully, being able to make sense of things. Crazy, uncertain times here, as always. So happy to navigate these markets with you. A couple quick comments before we go on. We do want to let you know that our podcast is clicking pretty good. We've had some really fun conversations over the last week with Jim Poplava of Financial Sense Wealth Management, all about managing risk, long-term versus short-term trends. He's been a long-time radio and podcast host in the financial industry, and it was a lot of fun to talk to Jim. Also, Doug Ramsey of the Lufo Group was the end of last week. A really good one about hedging strategy, some of the things he's looking at in their portfolios, also a money manager based in Minneapolis. And then I have an interview that's not quite posted, but should be hopefully later today, maybe tomorrow morning, my latest podcast interview with Jay Soloff. We talked about volatility, talked about the VIX futures. One of the questions we received today is about that particular topic. So hopefully will be a good reminder to go check out that video as soon as it's posted. I think that's it for now. Let's get to a market recap here and talk about how things played off. So this is a, quad witching day. I've actually had some comments about, why I'm not making more noise about triple witching, or what we now call quad witching day, which was today. To be honest with you, generally speaking, I have personally seen options expiration days like today. They tend to be a little more volume, a little more volatility, but directionally, I don't feel like those are major trend change kind of days. It just means it's going to be kind of a busier, choppier session. And then there could be some moves that maybe you want to be, just realize are more structural positioning changes kind of moves and not big directional bets. That's kind of how I thought of it. Other strategists and other traders certainly make a much bigger deal of quad witching day. If I was a day trader and trying to actually, move volume during the day, I'd probably be very focused on that. And I would guess, people you hear talking about the importance of quad witching days or triple witching days are probably more short-term oriented. And as a result, there's a lot more volume and participants and movement in things where you're used to not having as much. For me, I'm trying to think a little more medium term, longer term. So I look at a day like today and think about what it means for the overall trend and think about the different timeframes that I'm operating on. So I tend to think of expiration day as more noise. And then we get back to like the normal period starting next week where people are just making bets based on what they think is probably going to happen. And so that's probably why I don't make as big of a noise of it. But again, depending on your time frame, it could be very important. I don't want to minimize the value of being aware of those days, particularly if you're short-term oriented and do a lot in the options market for sure, or futures market for sure. All right. So what happened today? I mean, the S&P was basically a nothing burger. Now it opened lower. We traded just below 56.10, in the first hour of trading. And by the close, we did just slightly finish in the green. And that happened in the last 15 to 20 minutes of trading. The Dow also finished barely positive. The NASDAQ up about 0.5%. So at the end of the day, again, not a big move, but the markets did open lower and close higher, generally speaking. Small caps and mid caps actually still finished in the red. The VIX drifted about 0.5 point lower. So, volatility and volume on an expiration day, VIX actually came down a bit. So suggesting the implied volatility for the S&P 500 a little bit lower. So here we are finishing the week with the VIX below 20. I think that's an important data point. Certainly, and again, it's a brief market recap today, but as I reflect on some of these things for our weekly flight plan, which is my main report for my market misbehavior premium members, we'll certainly talk about the VIX being below 20 as a potential important data point to think about. The longer that the VIX remains below 20, it just tells me it's a low volatility environment, that the market is sort of calming down, and certainly within the context of a counter trend bounce that we've experienced here in the last week. Looking at bonds, you can see bond prices moved lower. The TLT about 0.5% lower. Generally, the yield curve drifted higher, particularly at the longer end, with a long bond yield finishing around 4.6%, 10-year point almost right at 4.25%, and the 5-year point's right at 4%. So rates are coming up just a little bit here through the course of the week. The dollar really just not much of a change today. Gold and precious metals moved lower, so the GLD down about 0.8%, silver down 1.6%, crude oil slightly higher, although energy stocks did not do particularly well today. Cryptocurrency is a bit mixed, although I would say the general trend in Bitcoin and Ethereum, kind of a risk-off move going into the weekend. While stocks kind of rallied, you didn't really get that similar move in Bitcoin or Ethereum going into the close of equity trading here. So Bitcoin currently right around 84,000, Ethereum right around 1980. So we're down quite a bit, obviously, from previous highs. Potential rotation higher in Bitcoin, but we're not really seeing that follow through yet. In the last 48 hours, I would say not really giving a big bullish vibe here. On the sectors side, the three FANG sectors, the Magnificent Seven sectors, finishing in the green. XLC up 0.8%. That's communication services, consumer discretionary up 0.3%. Technology about the same as well. On the downside, materials, real estate, energy, utilities, your four bottom performers. So sort of defensive and cyclical sectors at the bottom. Certainly growth sectors up at the top of the list. Again, that's I think the biggest question going into next week. I think we did a video on Stock Charts TV earlier this week about the NASDAQ 100 and talking about different potential paths. And it was all about, do you see the Magnificent Seven stocks, those leading growth names, resuming a leadership role? And I think if and only if you see that emerge going into the month of April, did the S&P and the NASDAQ have any chance of a meaningful improvement beyond what we've seen so far? Otherwise, I think it's going to be a meager rally. Breadth's kind of more negative than positive, although the breadth on the NASDAQ was a little more balanced, but most things kind of a 2-to-1 ratio of down versus up today. No change in our market trend model. Appears to be staying quite the same. We don't have time to go through a bunch of individual names, but things that I would be looking at, like Palantir, kind of having a nice rally, just pushing slightly above $90 a share going into the close. This is a stock that came down aggressively from 125 to like 75 within about a month. Nice rally so far, about 15 points off of that low a couple weeks ago. Would love to see that improve for sure, but for now, something to watch. Alta, a bounce higher today. Bullish and not a bullish and but bullish momentum divergence, I would say, potentially on the chart of Alta. Maybe ODFL is the one I'm thinking of. Yeah, ODFL is the chart that I'm thinking of there, with a bullish engulfing pattern on Friday, lower lows in 2025 on higher lows in momentum. Kind of a bullish momentum pattern there. I think that's it. I mean, Tesla up a lot, but again, looking at Tesla up or down a ton is not super valuable. I think the chart of Tesla is what reminds me what's so helpful about charts, because they help you put this 5.3% move into proper context. You can see that that's just that little, blip there on the far right side of this chart. The chart's still going down, or at the very least, or at best, I would say it's sideways over the last couple of weeks. But at worst, just a pause within a major downtrend. I'm not seeing enough of an improvement to really get excited here. But Meta and other names like that, as we think about wrapping this week, holding the 200-day going into the weekend, that's pretty encouraging. Netflix back above the 50-day going into the weekend. It's not bad. I think the question for both of those charts, for Netflix, do we regain the 50-day and aim toward those highs, get above $1,000 a share next week? For Meta, does this 200-day hold? I would say still an open question for now. We'll see if that's able to play out. All right, we're going to get to the questions. One other comment then before we get to the questions today, because we've had some really good ones. We do have a webcast coming up next week called Relative Strength. Top performers make top portfolios. I often have at the bottom of my charts a relative strength chart, a relative strength line, which shows you the performance of that stock or ETF versus a benchmark like the S&P 500. We're going to talk about some strategies using relative strength. I'll talk to you about ways that I scan for stocks demonstrating strong relative strength. Some of the names doing so right about now, the names that are outperforming during a market in a period of instability. You can sign up for that free webcast coming up next Wednesday, March 26th on my website, marketmisbehavior.com/relative, or just scan the QR code that you see on your screen. All right. Let's get to some questions here. Question number one, and thank you guys again. These come from all of you watching the show, answering questions or asking questions. I appreciate it so much. Let's get to it. Please show the weekly SPY chart with MACD, slowed stochastics, and ADX. How does this compare to the 2021 time period? This feels like a bit of a leading question, right? One of those where I feel like the answer is embedded in the question. Like you got a reason for asking me this. But I'll bite. Okay, so I've got the, weekly SPY chart. I'm going back about 7 years, and let's see, with MACD, slowed stochastic. So these are not indicators that I normally have. And the indicators I normally have are RSI and PPO, but I'll accept your question as read. So let's see, we got MACD, which is really pretty much PPO. They're almost identical, so I got that. We'll do slowed stochastics and the ADX line. Okay. All right. So we're basically, your question is look at now versus 2021. I mean, very similar, right? And so I guess what you're asking is, do you see similarities here versus there? I mean, hopefully by watching the show, it's pretty clear that I do, because I've talked about that comparison of late 24 to late 21 a number of times, right? And I would say the rotation from 2021 into 2022 with weaker momentum, weaker breadth reminded me a lot of the end of 2021. We even talked about the Hindenburg moment a number of times on the show, which really the last major sell signal you had was that in December of 2021. So I mean, the analog I think makes a ton of sense here. I guess what you're asking is, do you see similarities? The answer is 100% I do. And hopefully you've caught that, because I think we've talked about it pretty good. ADX I don't usually bring on here, but what the ADX is showing you, by the way, going down in like the second half of 21 and going down in the second half of 24, the ADX just tells you strength. So the higher the ADX, the stronger the trend. The lower the ADX, the weaker the trend. So toward the end of those very bullish years, you had a weakening of the ADX or a weakening in the trend, and that's kind of the same thing that you saw going into the first quarter of this year. And one of the things that I've talked about, because a lot of people, when we had this initial pullback mid-February into mid-March, a lot of people kind of comparing it to these pullbacks in 2024. But I think the pullback that we've seen so far reminds me a lot more of like that first wave down in 2022. And that obviously led to a lot further decline. So, I think no denying there are a lot of similarities there. And again, I think we've talked a lot about that relationship, the divergences in PPO, which is what I've talked about, certainly looked very, very clear. And now you're seeing an expansion of that as the downtrend begins. Recoveries and the way that you can tell that it's something like this, a pullback in April of 24 versus something like this, which was a bounce. It's things like, do we regain a key moving average? Do we break above a recent swing high? Does the momentum improve enough that those divergences are no longer there? Do you see any sort of, leadership rotation that would tell you that, investors are rotating back to an offense positioning as opposed to a clear rotation to defense that we've observed in the last 4 to 6 weeks? That is still an open question. I think, once we determine we're in a pullback phase, which I think we are, it's, do we continue to go, do we have any meaningful bounce that tells you that the bear case is done? And for me, I think of this market as guilty until proven innocent. I'm kind of assuming more of a 2022 than a late 24 at this point. And I could totally be wrong. And the way the chart would tell me that I'm wrong is that those charts that similarity no longer lines up as well as it has. So we'll see, right? I think it remains to be seen. So I appreciate you looking, asking about the comparing these points. And I would tell you that, I mean, the world in 2021 is very different. And I think that's the challenge right now is when you think of the interest rate environment, think about the dollar, think about the presidential administration and the news flow in early 25 versus early 22, pretty different. And so I think that's, it's the environment, the macro environment is not the same. However, from a technical perspective, the similarities 100% would agree. They line up pretty well. Great question. Thank you. Question number 2, is it possible to invest or trade using point and figure charts? What is your favorite book in that realm? You had a number of questions, who tends to specialize in these kind of charts and so forth. So for sure, right? Is it possible to invest or trade using point and figure charts? It absolutely is. If you're not familiar with point and figure charts, Stock Charts is actually a really good platform. There are a couple platforms that do point and figure charts really well. Unfortunately, there are a lot of platforms that do not do them particularly well. And I will tell you, the ones that are kind of known for doing it pretty well, Stock Charts is one of them. UpData is another one. Jeremy Duplessis, his last name is DU space PLESSIS. Jeremy Duplessis, and I'll put a link in the below the video for Jeremy's book, and also Tom Dorsey, his book. Jeremy Duplessis was helped create the UpData platform, which is again known as one of the better point and figure charting platforms out there. He wrote a fantastic book on point and figure charting, a couple of them. The name that I don't remember, but it really helped to think about different ways to consider point and figure charts, different ways to improve the toolkit, log scale versus simple sort of traditional scaling of the point and figure charts. And then Tom Dorsey, who ran a firm called Dorsey Wright for many, many years, eventually sold to NASDAQ. But Dorsey Wright, well known in the advisor community, because a lot of financial advisors I used to work with would subscribe to Dorsey Wright, and others as well, institutional investors as well. But it's a big advisor network that subscribed to Dorsey Wright's research, and it was all based on point and figure and relative strength and things like that. So those two have written some really good books. Tom Dorsey was a football player earlier in his life, and so his books, one of them in particular, compared point and figure charting to football, which I thought was really interesting. Is the offense or defense on the field? So what does a point and figure chart actually look like? So it looks like this, where and again, this is a methodology that was really proliferated in the on the pits in Chicago. And the reason why I'll answer your question, yes, is it possible to invest or trade using point and figure charts? Because I've seen it done. And I would go and spend time in the pits in Chicago, the CME, the SIBO, and guys would be using only point and figure charts to analyze the markets. This is using a log scale point. Is that right? Log scale, I think. No, traditional scale on here. This one that I'm showing, using a traditional scale, which is basically a really simplistic version of a log scale. So it uses $2 for each box. Each box represents $2. For Apple, and above 200, it turns to $4. So it's a really simple way of scaling it. You can use what's called a percentage. Where do we do that? A percentage. Here we go. Percentage scale, which is what I usually more prefer, which means it's kind of like using a log scale on your chart. It basically, each box represents 1%. And then you can track the trends higher or lower. A buy signal is when a column of X's breaks above a previous column of X's. A sell signal is when a column of O's breaks below a previous column of O's. So this right here is a really good sell signal for Apple, telling you we're making a new low with a new column and suggesting that there's further downside to be had. The beauty of point and figure charting is in its simplicity. Instead of price over time, which can be very noisy. Think of like a bar chart or a candle chart. Point and figure charts chart trends. So a column of X's is an uptrend, column of O's is a downtrend. So it's very simple. That's a rambling answer to the actual answer is yes, for sure. I would say for trading, there are shorter term versions of point and figure charting, and I'll leave it to like Tom Dorsey and Jeremy Duplessis. I'll put links to some of their books so you can get an idea of what's involved. They're great resources. For investing, what's really cool is you can actually scan for things demonstrating kind of classic buy and sell signals. This is on Stock Charts on their sample scan library. And if you scoot down a bit, these are all point and figure patterns. So that column of X's going above a previous column of X's called a double top breakouts. You can scan for stocks with that. A double bottom breakdown would be another sign. And then you have all these other different patterns, which are all patterns derived from the point and figure methodology. Looking for double top breakouts is a really good kind of breakout strategy, way to identify stocks kind of, pushing to a new swing high, pushing above a previous resistance level. That's a great way to, very systematically do so. So I've run those scans in stock charts, in UpData, which I used for a number of years. I would run those scans every day and actually have it automated so that it would share the results with me. The Chart School on stock charts has a really good resource where it actually shows there. I'll dig in and find the link to the point and figure section, and I'll include a link to those as well. So there are some definitely some books that I'll include, and then the Chart School is a really good resource. It's free and it's on stock charts, so I'll make sure that I include all of those below the video. Next question: what's the difference between the VIX index and the VIX future? I will let, and again, my interview coming up very soon with Jay Soloff includes that particular discussion. And so I will let him, tell in a lot more detail. But my quick answer is the VIX index, right, is basically an index that tracks volatility. It tracks volatility on some S&P options, S&P 500 options, and it's basically implying the volatility of the S&P 500. So basically, it looks at the options market, and based on the movement, the pricing of the options, calculates sort of an implied volatility. And one thing I did not realize, and I did, but I just hadn't thought about it in so long. I have this level 16 on here, and my conversation with Jay reminded me that a VIX of 16, based on the calculations, means you expect a 1% daily move in the S&P. That's kind of what that means. So anything above 16 means the market is pricing in a more than 1% average daily move, and anything less than 16 means the market's, the options market pricing in less than 1%. So it's basically how much the S&P is expected to move on average, not on an individual day, but on average. That shows you how the expectations have changed quite a bit. Now, the VIX index is not a security that you can buy. You can't buy the VIX because it's an index that is calculated from other things. They created VIX futures to actually trade on future expectations of the VIX. So you can actually go out and bet on the level of the VIX down the road, months and so forth. And so you can actually look at the term structure of the VIX to look at how expectations for volatility are changing going forward. So the VIX index, not a tradable security. It's an indicative measure, really an implied volatility. It's suggesting what the expected volatility of the S&P is going to be based on how options are trading. The VIX futures are futures that are derived and based off of the VIX index, and those are things that you can actually trade and bet on future levels of the VIX or future expectations for volatility. There you go. By the way, if you appreciate what we're doing on the show and you want to know more about the technical analysis tools, behavioral biases, and all the other stuff that we talk about, if that's of interest, you may want to become a Market Misbehavior Premium member. This is something that I started years ago, and it has been such a pleasure to build up a group of committed, engaged, like-minded investors analyzing the markets, looking for opportunities, learning the technical toolkit, and applying them real-time every day in the markets. 3 main benefits to the premium membership. Number one, all of our virtual courses. So we have a flight school on what I call behavioral investing, teaching you about behavioral biases, technical tools, consistent routines. I share with you a lot of my own toolkit and how I approach things. And we have a bunch of new courses planned here over the next couple years. You'll have access to all of those future courses as they're rolled out. You also have access to our members-only reports, like our weekly flight plan, which is our main report, where we talk about the week that just occurred. What did we learn? What was new? What was different? We look forward at the week to come and think about key levels and patterns and everything to look for. A lot of people have asked on my market recap show, why don't you do a big recap for the week? And I do. It's for premium members. And so if that's something you're interested in, I hope you'll check it out. I hope it pays for itself many times over by your ability to make better decisions and manage risk in your portfolio. Also, our monthly chart review, where we apply our proprietary market trend model to a bunch of ETFs every month. Then you'll have access to our members-only community. It is an active community. People asking questions every morning. I'm in there. I was in there earlier today answering some questions about, I don't even remember what it was this morning. Nuclear stocks, uranium and nuclear names. Someone asked about a nuclear ETF, so we're analyzing that on a couple different time frames. So it's great. It's a great group of investors asking questions, learning, and again, just trying to navigate these markets together. So if that's something you're interested in, go to marketmisbehavior.com, click on Become a Member in the upper right corner. It has all the information on pricing. Make sure you use the code YouTube when you check out for a special deal on your first 12 months on any plan. Hope you will check it out. All right. Next question. KSS has a high percentage of short. Does that mean the store is likely to go bankrupt? Awesome question. Let's go there. KSS, Kohl's. So I'm not sure. I don't have short data here on stock charts, but what you're basically asking is that it's got high short interest, or the way that you're asking it, and I'm pretty sure this is true, right? Has a high percentage of float, right? So float shares outstanding are all the shares out of a particular stock, all the shares that are publicly traded, but a lot of them are not actually accessible to the public because they're held by insiders and things like that. So the float is what you call the shares outstanding minus all those insider held things that are not actually out in the secondary market. The float represents the actual amount that is out there that you and I, going into a brokerage account, have the ability basically to access. So the percentage of float that is short, or what's called the short percentage of float, I think on a lot of platforms, is basically what percent of those outstanding shares that are available to the public are actually being used to support a short position. And Kohl's has a pretty high one right about now. So here's the thing. A couple things to say about something like Kohl's, right? I was taught prices go down for a reason. This is one of the many things that I learned in my journey that led me to trend following, which is the idea that I don't want to buy things going straight down. I want to buy things that are starting to work, which is why from a technical perspective, I would say it's hard to justify right about now buying a stock like Kohl's down around $8 a share, because it's still in a consistent downtrend, making lower lows, lower highs below 2 downward sloping moving averages. Not the type of chart I would generally have any interest in getting involved with. So that's one observation I would say about something like Kohl's. You also note some crazy dividend information, right? So they pay $2 a year estimated dividend, and the stock's now trading at like $8 a share. So literally 24% dividend yield. So you buy a share for $8 and you're getting a $2 dividend. Now that dividend may be completely unsustainable. The problem, and not to go too completely off the wall with your question, but the problem for Kohl's is they got a ton of debt. Their same store sales are down pretty consistently year over year, quarter over quarter for a long time. And again, I'm not a fundamental analyst, but I do know how to analyze companies fundamentally. And I can tell you, I mean, if you look up any information on Kohl's, it's not great. So what does it mean that that Kohl's has a high percentage of short? That means that an extremely large number of people are betting on what you're asking, are basically betting on Kohl's going to zero or going bankrupt, which means that the stock is essentially liquidated. And so people are just betting on this price to continue to go down. So does that mean it's likely to go bankrupt? I mean, it has no impact on the company's ability to actually meet their debt obligations and function as a business. That's separate. Does that, the price going down with heavy short, does that mean the management of the company, which has had some turnover, does that mean their jobs are a little less secure? It certainly does. The price going down really shows you how the market has very low expectations for Kohl's ability to make things better, and otherwise the price would start going up. So the fact that price is going down so much with such a heavy short component means a lot of people are betting on this thing to not really recover in any significant way anytime soon. The one thing to remember, though, is at some point, if Kohl's does survive and does actually have a meaningful low and starts to pop higher, when the short percentage gets to such a high level, you have the potential for what's called a short squeeze, right? Let's say Kohl's all of a sudden has a dramatic turnaround of some sort, right? All of a sudden the price starts to rotate higher because expectations all of a sudden start to get dramatically better. Not a likely scenario based on what the market's telling you here. They just had earnings in early March, and you can see what happened. We gapped down again. But let's say things start to improve and some news flow tells you Kohl's is actually a pretty good idea. Stock starts to go higher like this. all these tons of people that are short all of a sudden have to meet a pretty rough margin call where they have to pitch in a bunch of extra money to support that short position, which is now underwater. It's called a short squeeze, because then they have to close their short position, or the broker closes it for them to cover their underwater position. That covering of the short position is basically another buy. And so a bounce in a stock can actually fuel a significant rally. So going back to like the GameStop debacle was basically hedge funds getting caught on the short side, and all of a sudden they have a horrible losing position that they have to address. And so a short squeeze is when there's a bunch of people short. They all get trapped on the wrong side because the price goes higher. They have to liquidate or cover their short. The price continues to go higher. So that's the risk of being short at this particular moment. Is it's such a crowded trade that if you're proven wrong, it's going to be a flood to the exits, and the price can rally very quickly, and you lose a lot of money in a very short period of time. So a lot of people actually scan for stocks showing a high percentage of short, because those are names they might bet on an upside reversal, because they've already been beaten down so much. If the company survives, maybe that's going to be a winning trade to push higher. And I would say if you're buying Kohl's right about now, at least a short squeeze has to be part of that thinking. That's one of the only things I could say would motivate me to look at a chart like that and say, whoa, that's probably a good place to buy the stock. Hopefully that makes sense. Sorry, I kind of rambled a bit on a lot of things, but Kohl's is one of those. I get a lot of questions on like, is it down? Is it so low I should buy it? And one thing I've learned is price goes down for a reason, right? Any thoughts on the end of quarter rebalancing at large money management firms? For sure. And we are getting, we just had quad witching or triple witching today, end of next week. And the week after that, we get into the end of March. That's the end of Q1. So end of quarter rebalancing is basically, at the end of every quarter, the logic behind this is at the end of every quarter, money management firms take a snapshot of their portfolios, because they have to file quarterly reports and they have to send reports to all of their shareholders on here's what the fund did. So you basically take a snapshot of your fund on, at the end of December, and then you don't take another snapshot of your holdings until the end of March. So between December and March, you can do all sorts of crazy stuff. You can go way out of your mandate. You can buy whatever you want and put in your portfolio. But at the end of that quarter, you better clean things up, because otherwise there's going to be an official snapshot of your fund with a bunch of things that you might not want in there, or you might not want your shareholders to know exactly all the things that you may have had in there. And so you kind of clean it up. They call it the quarter end, window dressing is part of it. It's kind of neatening up the portfolio. That's part of it. Also rebalancing, which means if a bet has become too big, because a lot of times you kind of get lazy and you let something that's working, like gold, for example, becomes really big, because it's just the price has gone up and other things have gone down. So as a result, that becomes a big weight in your portfolio, and you don't necessarily want it to be that big of a weight. So a lot of times what happens are things that have been working pretty well, you'll kind of get them, pulling back a little bit. Things that have been struggling a bit may actually, move higher a bit, because anything that's come down a little bit, you're probably underweight. So you need to add some exposure. Things that have gone really well, maybe you're overweight, you need to reduce exposure. So there's a lot of different competing narratives, and depending on what's happened going into quarter end rebalancing, things can happen. At the end of the day, I'm not, to be honest with you, as much as that makes sense anecdotally, and I know some of those things happen, is there a specific market outcome I think you can project because of quarter end? I don't think so. And particularly given this quarter where, growth stocks like AI trade and everything so strong, but it's come down so much. So I think a lot of weights have actually probably come down already quite a bit. So I don't know if that would be something that would be a big, watch out, because the Magnificent Seven names are probably all going to drop because people are still overweight. Like maybe that's probably not as big of a deal anymore than it was, before a 10% loss in the S&P and the NASDAQ. So I've never really seen any great statistically significant evidence that tells you here's what tends to happen at a quarter end rebalancing, and here's why. Anecdotally, I would say there's a lot of sort of artificial movements where it's more about, taking, if any bets have made your portfolio get out of your portfolio mandate, you need to make changes before the end of the quarter to make sure that it looks as it fits in with what you've agreed to do. And it doesn't mean you've done dishonest things during the quarter. It just means once a quarter, you have to take that official snapshot. So things can kind of move around, and then you need to kind of reset and say, okay, where are we at? Do we have the right percentages? And so those are some of the things that you could expect. Again, given all the uncertainty, I mean, how does that fit in relative to geopolitical risk and all of the news headlines from Washington with policy change? I mean, interest rates and the Fed, earnings, all of those things I would argue are way more important right now in terms of market moving potential than quarter end rebalancing. That's one of those things, like if nothing else is going on, that's something to think about. In this case, I'm probably not going to spend a lot of time dissecting what that's going to potentially mean, because I don't think it's going to have as much of an impact as you might expect. That's it for today, and that'll be a week here for Chart This with Dave Keller. I want to thank you guys so much for watching me and following the content here on my show. Thanks for watching the live stream on all the platforms where we're at. It's been so much fun. We're about 6 months in on the new show called Chart This, and it's an absolute fun to do it. It's so much fun. I really appreciate those of you that have joined and have asked questions and made it a really interesting, engaging, interactive discussion every day. Please keep coming, and please keep asking questions and keep engaging. And I'll look forward to keep looking at charts and sharing with you as many insights and educational points as I can do. That'll do it. Have a fantastic, restful, wonderful weekend. And remember, it's always a good time to own good charts. Take care, folks.